One more time. Yes, come to order. The hearing of the Congressional Oversight Panel will now come to order. This is the first field hearing of the Congressional Oversight Panel of the Emergency Economic Stabilization Act of 2003. I want to begin by thanking our hosts, the Boyd School of Law of the University of Nevada at Las Vegas, where I count many of my close friends. I want particularly to thank President David Ashley and Dean John White. I think both of them are with us. Would you mind standing so we can all say thank you? Universities and law schools in particular have a unique role to play in civic life, and I think this is a very important example of that. And so I am grateful, the entire panel is grateful, for the willingness of those at UNLV to come in on very short notice and to work very hard so that we could put this hearing together. I also want to add that we received generous assistance from the offices of Senator Harry Reid and Congresswoman Shelley Berkeley. We're delighted that Senator Reid and Congresswoman Berkeley, as well as Congresswoman-elect Diana Titus, will be joining us. Dina. I'm sorry. Congresswoman-elect Dina Titus will be joining us during the course of today's hearing. Actually, I am particularly embarrassed because I want to be able to say publicly how tickled I am to have the opportunity to meet Congresswoman Titus because she is responsible for doing something that I didn't think anyone could do, and that was to manage to get through, when she was still a state legislator, a ban on universal defaults in consumer contracts. And so my particular kudos in that case. It's a remarkable achievement given how much the odds are stacked against it. So I'm particularly looking forward to this opportunity. In September 2008, the Secretary of Treasury, Henry Paulson, issued a strong warning to Congress that without massive government intervention, the U.S. financial system faced the possibility of imminent collapse. In response, on October 3, 2008, Congress passed the Emergency Economic Stabilization Act of 2008. Authorizing the Treasury Department to commit up to $250 billion in taxpayer money, to be followed by another $100 billion and another $350 billion if warranted. The statute also created this oversight panel at a considerably smaller cost. The Act's purposes are to, quote, restore liquidity and stability to the financial system of the United States in a manner that, A, protects home values, college funds, retirement accounts, and life savings, B, preserves home ownership and promotes jobs and economic growth, C, promotes overall returns to the taxpayers of the United States, and D, provides public accountability. Congress created the Office of Financial Stabilization within Treasury to implement a Troubled Assets Relief Program, cleverly known as TARP. At the same time, Congress also created a Congressional Oversight Panel, with a far better acronym, COP, to review the current state of financial markets and the regulatory system. COP is empowered to hold hearings, to review official data, and to write reports on actions taken by Treasury and financial institutions and their effect on the economy. Through regular reports, COP must oversee Treasury's actions, assess the impact to spending, to stabilize the economy, evaluate market transparency, ensure effective foreclosure mitigation efforts, and guarantee that Treasury's actions are in the best interests of the American people. In addition, Congress has instructed COP to produce a special report on regulatory reform that will analyze, quote, the current state of the regulatory system and its effectiveness at overseeing the participants in the financial system and protecting consumers. We are here today to investigate, to analyze, and to review the expenditure of taxpayer funds. But most importantly, we are here to ask the questions that we believe all Americans have a right to ask. Who got the money? What have they done with it? How has it helped the country? And how has it helped everyday Americans? As part of that ongoing effort, we reach out to you. We can read the statistics and we can analyze the data, but we want more. We come to Nevada to learn from you about the current economic crisis and the impact, if any, of the nearly $350 billion that has been committed to the financial institutions and the AIG insurance companies so far. One quick word about this panel. We've been in existence as a group for less than 3 weeks. Instead of spending time to set up our offices, hire an extensive staff, and develop a timeline and a strategic plan, we jumped directly into the task at hand. We've met with representatives of the Treasury Department, the Federal Reserve Bank, and the GAO. We have read documents and requested information. And we now have 2 things. We have our first report, which is on, and we have a website. The 2 are together. The first report is posted on our website. It's cop.senate.gov. That's cop.senate.gov. And you can go there and download the report, cut and paste it, do what you want to do if you'd like to read it. But most importantly, what we also hope to do with that website is not just have us talk to you. We hope that you will use it as an opportunity to talk to us. And that is that we're setting up within the website, it's still in its beginning phases, but an opportunity for you to tell us what's happening to you in this economy, how it is that you're experiencing the current economic crisis, and to talk with us about the questions we are asking of the Treasury Department. Further to that, we have invited witnesses today, and their testimony will be posted on the website so that people all around the country can read it. But we recognize this is an opportunity for a public hearing. And so we will have out in the lobby, starting I believe now, a video camera. We have someone out there who will give you the same 5 minutes the witnesses get here to tell your story, to tell whatever story you want to tell about this economy, about the Congressional Oversight Program, and about the actions of Treasury so far. We hope to be able to use some of those. We will look at them when we're not here. We recognize the constraints of time. And we also hope to be able to use them to feature some of them on our website so that others have the opportunity to hear from people in Nevada about what's going on in Nevada. So we hope you will take advantage of that, as many of you as possibly can. We arranged this first meeting in great haste, imposing on our skeletal staff and more often on the kindness of our friends to put together this event in less than a week. We are especially grateful to everyone who contributed to this effort. But I mention the tight deadlines and our quick response to emphasize a different point. We take this task very seriously. Our country is in peril. Taxpayer dollars are flowing into banks, but there is little evidence what effect these hundreds of billions of dollars are having on the very obvious troubles facing us: mortgage foreclosures, constricted small business lending, and rising unemployment. We are here to learn from you and to take what we learn back to Washington. We appreciate your coming here in person, and for those of you who join us online, for telling us your stories, and I hope you will join us again on our website. With that, I will be quiet and listen to you, and next we will have our opening statement from Damon Silvers, one of our panelists. Damon?
Good morning. I'm very pleased to be here in Nevada for this first hearing of the Congressional Oversight Panel. I want to express my appreciation to Senator Harry Reid, Speaker Nancy Pelosi for the opportunity to serve on the panel, and to the congressional leadership and their staff and the good people here at UNLV, and to Congresswoman Berkeley and Congresswoman-elect Titus for all of their help under the extreme time pressures that we ask people to act under, as Elizabeth indicated. I also want to express my appreciation to our chair, Professor Elizabeth Warren, for her leadership in getting our panel off to such a fast start. Professor Warren has worked tirelessly over the past 3 weeks, giving voice to the concerns of the American people. It is also an honor to serve on the panel with my 2 distinguished fellow panelists, Congressman Jeb Henseling, who is unable to be here with us today, and New York State Banking Superintendent Richard Neiman. In the 3 weeks since the panel's first meeting, we have had the chance to meet with many dedicated public servants at every level, in the Treasury Department, in the Government Accountability Office, the GAO, and other government agencies who are working as hard as they can to try and stabilize our economy. Whatever the panel's concerns are and may become regarding policy, strategy, or execution, our concerns should not be read in any way to diminish the great respect and gratitude that we owe for those folks, for the public service that they are rendering in their effort to serve our country in this economic crisis. Since early October, the Treasury Department has provided banks, private companies, with $165 billion in public money, taxpayer money, in exchange for preferred stock, plus an additional $60 billion to two companies, Citigroup and AIG, and they have made commitments to allocate more than $100 billion more to banks and to buy asset-backed securities. In total, these very large numbers amount to more than $1,000 for every single American. Each of us has to be concerned about the specifics of these actions taken under the Emergency Economic Stabilization Act of 2008, actions which every person I know who is not actually involved in the policymaking process refers to as the financial bailout. When Congress created this panel, Congress asked that we report every 30 days on our oversight work. Last week, we issued our first report. The report was, in its essence, a set of 10 simple questions, together with some explanations as to why we felt it was necessary to ask each question. These basic questions cannot be answered through a dialogue among Washington insiders. They must be the subject of a national conversation, a conversation that starts off with what is actually happening in our communities, communities like yours. Can business people borrow money to run their firms? Are foreclosures getting better or worse? Are employers hiring or laying off workers? Are local financial institutions being fairly treated by our federal government? And the opportunity to get answers to these questions is why I'm so pleased to be here in Nevada today. Because we need to know how the Wall Street bailout looks from here. Has it helped? Is there less fear here in Nevada than there was in September and October? Is the bailout being fairly managed? Is the Treasury Department's plan thoughtful in relation to what has gone wrong in the economy here? Do Nevadans, whose tax dollars have been used to help fund the bailout, feel that you have enough information about how your money is being used? Do you feel that there has been accountability for the financial sector? Now, some involved in managing the bailout have said that the measure of success is not in what has happened, but in what has not happened. That we've prevented a complete halt to all financial activity. When Hank Paulson asked Congress to act in September, and then when he chose, together with British Prime Minister Gordon Brown, to put money directly into the banks in October, he certainly had good reason to believe that we faced the risk of systemic breakdown. But it is difficult to assess this kind of argument. Because while it's true that our economy is in grave trouble now, today, it could always be worse. And it can be hard to know whether by our actions we are actually making it better. So our panel needs to look deeply in the coming weeks into the extent to which we have stabilized our financial markets and whether we could have done a better job. But when we do so, we must remember that the financial markets do not exist to serve themselves. Markets exist to move resources to productive activity so that all of us are better off. If the financial markets are not achieving that end, if the innovative entrepreneur, the builder, the business person, large and small, cannot obtain financing for viable businesses, then we have not achieved our purposes in seeking to stabilize the financial markets. If a downward spiral in housing prices driven by foreclosures, falling incomes, and rising joblessness keeps our major financial institutions on the brink of collapse, we have not repaired the real economy, and we have not really even stabilized our financial markets. As we make these inquiries, we need to remember that our economic problems are not ultimately about finance. This recession and its associated financial upheavals are driven by structural problems in our economy, and in particular, a long, futile effort to maintain high consumer spending while in reality wages stagnate and our productive capacity shrinks. Some of us in the East don't understand about Nevada that for decades there have been good jobs here. The hotels here in Las Vegas employ tens of thousands of workers who earn a living wage, have health insurance and a pension, doing jobs that in other parts of the country often pay only poverty wages. Labor and management in Las Vegas built a service sector middle class in the 80s and 90s, which is now under pressure from a national economic model that is not working. The truth is, if America is in economic trouble, if the American middle class is under pressure, the middle class in Las Vegas will feel the pain. In a very real way, our economic fate as Americans is woven together. But our national strategy in recent years seems to have been to look to the financial sector, to borrowing, to leverage, to generate wealth. That strategy has failed, and the vain pursuit of it has made our economic situation far worse than it might have been. And now we run the risk as a nation of making the mistake of thinking that if we only cut our incomes, we can get through this crisis. That the best employers are those that pay the least, the best bankers those that lend the least. The truth is that these deflationary strategies will only make things worse, much worse. So the questions we as a nation should ask about the $225 billion that has been handed out are we really stabilizing the financial system and improving our economy? And second, are we laying the foundation for a financial system that can really work to move capital toward productive uses and appropriately manage risk? In the pursuit of answers to these questions, I hope our panel will visit every corner of our country. In the weeks and months to come, we need to hear what the public, business people and consumers, workers and homeowners have to say about how the public's money is being used to stabilize our economy. Thank you.
Thank you, Mr. Silvers. Mr. Neiman?
Good morning, and thank you all for appearing here today, especially those who are here to testify, those who are here to learn, and particularly those who are here because they care. I also want to especially thank the media here, and there are a number of television and print, because that way all citizens and members of the public across the state will have an opportunity to participate in today's event. I also think it's especially appropriate that we are starting our first meeting here in Nevada, the epicenter of the foreclosure crisis. I don't have to tell anyone in this room that Nevada ranks first in the nation for foreclosure filings, up more than 100% since last year. The turmoil in the financial markets has literally hit home here. Now, we all come from diverse backgrounds as members of this panel. We've been asked to serve as citizens by Congress on this unique experience. I come from a state, New York. We are not nearly as severely impacted as a state as you are. However, pockets of New York are being disproportionately impacted. Whole areas of communities like Brooklyn and Queens, which account for over 30% of all foreclosures, are being devastated by series of foreclosures impacting concentrated areas in those communities. Over 20% of foreclosures are on Long Island, being significantly impacted where there is an extreme shortage of affordable housing. So I can relate to the challenges you are facing here in Nevada. It may seem overwhelming when entire communities risk being destabilized. Unfreezing credit markets is vital, but lasting stability also must address the needs of families losing their most valuable asset, their home. So a lot of these efforts, foreclosures are a local issue. They impact states, they impact communities, and they impact families. And much must be done at the state level. In New York, Governor Patterson, I chair a interagency task force for over a year and a half that we refer to as HALT abusive lending transactions. We are addressing foreclosures and the impact of the housing crisis across a continuum of progressive approaches to stem the crisis. From direct outreach to borrowers, connecting borrowers and lenders to sit down and modify mortgages, to new legislation at the state level, to significant grants to home counseling agencies and legal aid groups, and increased enforcement against unscrupulous mortgage originators and other participants in the mortgage crisis. However, only so much can be done at the state level, and that's why there's such an important need for action at the federal level, and that was the impetus for the Emergency Economic Stabilization Act, which gave rise to this important panel. We are looking for, the panel includes a diverse group, as you can see, among us as members with diverse backgrounds from a union and academic and consumer interests, as well as myself from industry and a regulatory agency. But even more importantly, we're out to hear from you as stakeholders among an even more diverse group of citizens, from industry, from consumer advocates, from state and local officials, and from academia. So we are here to hear from you. This is your day, and I'm going to turn it back over to Elizabeth so we can get started, and I look forward to an extremely productive morning. And thank you for giving me the opportunity for those introductory remarks.
Thank you, Mr. Neiman. We'd like to start with statements from Congresswoman Berkeley and Congresswoman-elect Titus. If you could join us, come to the table. Congresswoman Berkeley, thank you very much for being with us. The chair recognizes you.
Thank you very much. I want to particularly thank you, Chairwoman Warren, and thank all of the panel for traveling to Las Vegas to see firsthand how the nation's economic crisis is affecting our community. Mr. Silvers, I'm going to help you understand the state of Nevada.
I tried.
You tried. Here in Las Vegas, we have become accustomed to leading the nation in many different categories, and that's usually a very good thing. Population growth, economic strength, number of satisfied visitors that come to our community. Las Vegas has been a boom town. Just to give you some idea of what it has been like growing up in Las Vegas over the last several years, many, many decades now. Unfortunately, the problems caused across the nation by the current economic downturn have been magnified in Nevada. We've had the highest foreclosure rate in the country for most of the last 2 years. Our unemployment rate was at 7.6% in October. I suspect it's substantially more than that, and Danny Thompson, head of the AFL-CIO, will speak to the fact that thousands and thousands of his members are out of work and idled. Our unemployment rate, unfortunately, continues to climb, and the number of people flying into Las Vegas to enjoy our wholesome family entertainment has decreased for the last 12 straight months. The airlines have cut 20% of their flights to the Las Vegas Valley, which has had devastating consequences for us. Our community is suffering. My constituents are suffering, and there's not much good news on the horizon. When Secretary Paulson came to Congress requesting unprecedented power and funding to rescue the financial industry and restore the flow of credit, I was extremely skeptical that this strategy would work or that enough conditions were attached to ensure accountability and transparency. I initially voted against the bailout, and I'll tell you why. There were 3 reasons. One was I didn't think there was enough control over executive compensation. There was some language in there, wasn't strong enough, and if you read the Las Vegas paper yesterday, you would have seen that there's a report saying that executive compensation continues as usual because of a loophole that was included at the last minute in the bailout bill. The second one was, with all due respect, and please know how grateful I am that you are here, I thought the Congressional Oversight Committee was window dressing, to say the very least. I mean, this is an after-the-fact thing. The money is gone, and there was no oversight. Secretary Paulson gave the money where he wanted to give it. There was nobody, certainly nobody in Congress that had the authority. We gave the authority away, and the money is gone. The authority never existed, and there's no accountability. The third was a judicial review section, which I thought was, in all due respect, a joke. The only way that Mr. Paulson can be held accountable for his actions through judicial review is not if he violated the intent of Congress, which I believe he has, not if he's violated the statute, but if he violated the Constitution. So as an attorney, I was thinking, how does one violate the Constitution? It seems to me unless Mr. Paulson is accused of committing treason or owns slaves or keeps women from voting in this country, there's precious little we can do when it comes to judicial review of his decisions. I reluctantly supported the final legislation only after being assured that the need was great and the oversight would be vigorous. This is what was said to Congress, and I am quoting almost verbatim. The purpose of this was to buy up toxic paper, unclog the pipes of the financial industry, and get money and credit into the pipeline. Get the credit and the money flowing again. In the 2 months since I cast that vote, Secretary Paulson has used almost $350 billion to prop up Wall Street banks and investment companies, but little has been done to help the people of Las Vegas and other communities across the country who have already lost their homes or who will fall victim to foreclosure soon. As an added insult, the Government Accounting Office reported recently that the Treasury Department has no way of knowing whether the billions already allocated are being used merely to pad the financial industry's bottom line rather than increase lending and limit foreclosures as was Congress's intent. The bottom line is there's no discernible impact from TARP money. TARP was supposed to set the floor, has not set the floor, and that has not created the necessary stability to give the banks the confidence to lend the money. Now, I keep hearing from people that this is a crisis in confidence. Well, perhaps that is true. However, it is very difficult to tell someone that has lost their job and their home in the same week that this is a crisis in confidence. It's a little bit more substantial than that. And believe me, I understand what it's like to want that American dream of home ownership. When my family moved to Las Vegas, everything we had was in a U-Haul hooked up to the back bumper. Now, when we finally bought our first home in Vegas, it gave us a feeling of stability and power. We had roots in this community. We were somebody. We were homeowners. We belonged here. We made Las Vegas our home. I understand how my constituents feel about that. It gives you a piece of the rock. And I cannot even begin to imagine the devastation it would have caused my family if we would have lost our very small but our very first home to foreclosure. It's more than that. It's more than people that have lost their homes. And let me give you 3 very quick vignettes. I met with my car dealers yesterday. They've got millions of dollars of inventory sitting on their lots. They have willing buyers coming into their lots, and they can't get them financing because the pipes are still clogged. So people that are credit worthy still can't get the credit that they need in order to do the second biggest purchase of their lives for most people, and that's a car. That's killing the car dealers, killing them. I have my stepdaughter I'm very proud to say, has just become a doctor and started practicing here in Las Vegas in September. She has signed a multi-year contract. She has an income coming in, and a rather substantial one. She could not get a loan for a house. Because why? Because there's no liquidity. The banks are not lending money even to credit-worthy people. And finally, another quick example. One of the most successful business people in the Las Vegas area, if not the United States of America, has the second largest timeshare company on the planet. Golden Credit is having all of his loans called in for absolutely no reason. Nothing has changed other than that lack of confidence and the banks wanting to guarantee their money. And it's creating havoc, I can assure you. I appreciate the efforts of this Congressional Oversight Panel to highlight exactly what the economic crisis has meant to families of Southern Nevada, whether the TARP is actually helping. I also am delighted that you're going to take a tour of Las Vegas. You'll be in my congressional district. You're going to see the devastation of home after home after after home in foreclosure, what it's doing to neighborhoods and what it's doing to property values. The witnesses you will hear from today bring a variety of important perspectives to this hearing, but each are going to deliver the same message. Our community is hurting. We could use some help. Now, let me say this, and I have a couple of other things I want to say. I remain optimistic. Our nation has survived far worse than this, and we've come out stronger. And while it's not under your jurisdiction, I believe that infrastructure stimulus package that we're going to pass in January is going to make a tremendous difference, because we have a crumbling infrastructure in this country. And if we are going to remain a superpower with a future, we're going to need to shore up that. Number two, energy legislation. We need to get away from foreign oil and start tapping into renewable energy sources. It's an economic imperative, an environmental imperative, and I believe a national security imperative too, and it's good for the future of this nation. Also, the way we do health care in this country is backwards. We spend billions of dollars in end-of-life care rather than pouring those billions into early detection and prevention of disease, research and development. This crisis may be the catalyst for making those necessary changes for the 21st century. But before we do any of that, we have to solve our financial crisis. Let me give you 4 things that I have found are would help a lot. My homeowners still have no one to renegotiate their loans with. And at the end of this month, millions of loans across the country are going to be reset higher up. People are going to be losing their homes. There's nobody to talk to. There's no telephone number. There's nobody on the other end of the line that can say, all right, you can afford to stay in the house for $1,100 a month, your current mortgage payment, you're reset to go up to $1,600 a month. Let's renegotiate this loan. Who are these people going to talk to? There's nobody yet, and we need to provide that for them. I am sure the banks would rather have somebody paying a mortgage, even at a lower amount, than nobody in the house. It's certainly good for the municipalities and the states as well. I believe there's no consistency between the Treasury and congressional intent and the FDIC and what they're doing. The regulators are overcompensating, and that's why credit-worthy people like my stepdaughter can't get a loan. They're putting the thumb down on the banks. We're giving them the TARP money, and there's so many rules and regulations to overcompensate for what they didn't do that created this crisis, that they're not freeing up the liquidity that we need. Number 3, end naked short selling. I mean, it's killing us. And suspend mark-to-market. And there hasn't been a businessman that I've spoken to that hasn't begged for those things, and the banks as well. Because if it's at the current, if it's valued at $500,000, but it's only worth $300,000, and the banks have to write off the $500,000, they're using the TARP money for that instead of putting it in the pipeline so that my consumers can get that credit. I thank you very much for your kind intention. I know I went a little long. I've got much to say, and I need to take care of my constituents because they depend on me.
Thank you very much, Congresswoman. I applaud your enthusiasm, and thank you for hosting us here. We really do appreciate the help you gave us so that we could be here today.
You're here at my alma mater, and I'm very happy to have you here.
Thank you. Congresswoman-elect Titus, it's a pleasure to welcome you. Please give us your statement.
Well, thank you very much, Madam Chairman. That's always a hard act to follow, I can tell you. Madam Chairman, members of the committee, for the record, I'm Dina Titus. I'm the newly elected member of Congress from Nevada's Congressional District 3 and a former minority leader of the state Senate since '92. And I very much appreciate, Professor Warren, your comments about some of my work in the legislature. I'm pleased to join my colleagues in welcoming you to Las Vegas, and I'm encouraged by your presence here to gather information on our very serious housing and mortgage foreclosure problem. As you know, as you've said, and as you will hear repeatedly, Las Vegas has the worst foreclosure rate in the country, and CD3 is the worst of the worst. CD3 includes the suburbs and the surrounding communities where the greatest growth has occurred in the recent decade. In the numerous developments that ring this valley that have just sprouted up like mushrooms over the past 10 years, speculation has run rampant, and we see the result of that in the high foreclosure rate. Companies and individuals scooped up blocks of houses with mortgages that were too good to be true, anticipating that they could sell the houses off at a profit before they had to pay the piper. Unfortunately, it didn't work that way. There were other individuals who, as Congresswoman Berkeley mentioned, who were just trying to realize the American dream at a time when economic prospects looked really good. Never did they dream that within a few months or a year or so, they would be without a job. Nor did many people understand the complex financial instruments and terms and arms, etc., that were part of the lease or the mortgage that they signed. Who can read and understand those terms in the fine print when many of those haven't even been recognized or defined in the financial world and certainly have not even been regulated? As a result, it's been estimated that maybe as many as 1 in 40 houses in this district is in some form of foreclosure. Now, you take that problem and you couple it with the highest unemployment rate that Nevada has had in 25 years. In addition to that, we have a national economy that has hurt our gaming industry because there is no disposable income for people to use for taking a holiday. In addition to that, the revenues at the state and local level are down because property taxes down, sales taxes down, real estate transfer taxes down, and the result is those governments have had to cut services that would help the people who are now in trouble. So you overlay that with this foreclosure disaster, and Southern Nevada is on the brink of an economic crisis. We used to pride ourselves on being recession-proof, but that is no longer the case. People used to feel like if they had 2 nickels to rub together, they'd go to Las Vegas, gamble it, and perhaps change their fortune. Not so much anymore. Now we are in trouble, and we need your help. I understand, I wasn't there, but I've tried to study it, that the Emergency Economic Stabilization Act was passed by Congress with the best of intentions to encourage the banks to free up credit, to invest money back into the economy, and to allow the Treasury to buy those troubled assets. It was highly touted, and we saw this by the pundits and the policymakers alike, as a measure to address the foreclosure crisis. As yet, however, we've seen very little help on our Main Street level here in District 3. And now the message has changed. As I understand it, Secretary Paulson now says he's not going to buy up mortgage-related securities. One day it's one thing, the next day it's the next. I believe that until the Treasury Department uses its authority to more aggressively and directly address the housing problem, hard-working families in CD3 will continue to face the problem of foreclosure. We need for banks to use the money that they have to refinance mortgages, to restructure loans in meaningful ways that don't foster re-foreclosures within a short time, because we have seen that happening, to get involved before delinquencies in payments occur, so you get on the front end of things and not the back end, and to pursue rent-to-buy options as certain possibilities. And we need to focus first on those owner-occupied homes. Those are the people who are there who need our help. And as you have said, Madam Chairman, and as the recent GAO report pointed out, we need more transparency. The taxpayer needs to know who's getting the money, how much are they getting, where is it going. What are the state and local governments really doing with their neighborhood stability or stabilization funds? And why is it taking so long? In short, we cannot allow financial institutions to ignore the intent of the law to aid in the reduction of foreclosures, because I believe that addressing the housing situation and creating jobs are the keys to turning our economy around. That's certainly true in Nevada. While individual lenders, investors, builders, and borrowers must accept the responsibility for their actions, we also have to remember that this crisis not only affects that family that loses its home, but it also affects the neighborhood. From lower property values to foregone revenue, the entire community suffers. And we have seen that throughout District 3. A house is vacant, the lawn dies very quickly here without water. Then the graffiti comes, the vandals come, the windows are broken, the swimming pool turns into a feeding ground for West Nile virus mosquitoes. You see the whole neighborhood goes downhill instantly, and we just cannot allow that to happen. So thank you very much for being here and for giving me an opportunity to tell you how critical this problem is and how much we need your help to diversify Nevada's economy, keep people in their houses, get people back to work, and turn this country around. Thank you so much.
Thank you. Thank you both for joining us. And now I ask if the first panel could be seated. Thank you. Thank you. Today's hearing will consist of two panels of witnesses. The first panel will address the causes of the current foreclosure crisis in Clark County and their relationships to the broader financial crisis gripping the country. The second panel will focus on the impact of the crisis on the local economy and how it has affected working families in Clark County. We're joined on the first panel by George Burns, a commissioner of the Financial Institutions Division of the Nevada Department of Business and Industry, William Uffelman, President and CEO of the Nevada Bankers Association, and Dr. Keith Schwer, Director of the Center for Business and Economic Research here at UNLV. Thank you all for being here today. I ask you to please limit your oral remarks to 5 minutes. Your full written statements will appear in the official record of the hearing. Mr. Burns, could you start us, please?
Good morning, Chairman Warren and members of the panel. My name is George Burns, and I am the Commissioner of the Nevada Financial Institutions Division. I'm honored to have the opportunity to testify on the banking and economic environment in the state of Nevada and the Treasury's Troubled Asset Relief Program. This panel provides an important mechanism for oversight and accountability of this program and the future of our regulatory structure. I'm very pleased that my colleague, Richard Neiman, has a critical role in this process. As state regulators, we play an important role in ensuring local economic development while protecting consumers. As we evaluate the effectiveness of the various government programs and contemplate our future regulatory structure, it is important for Congress and the administration to hear and learn from the experience of state officials. Today, I will share my perspective on the effect of the mortgage and financial crisis on state-chartered banks and bank customers in Nevada, the strategy behind and effect on the Nevada banks of the Treasury Department's use of TARP funds through its capital purchase program, and my recommendations on the use of future TARP funds to help the banking industry in the state of Nevada. I would also like to share my thoughts on the broader issues surrounding the TARP and regulatory restructuring. Nevada, as the rest of the nation does, finds itself in one of the most challenging financial situations since perhaps the 1930s. Two studies, one done by the National Conference of State Legislators and other completed by the Rockefeller Institute, state that Nevada has suffered significantly more than the rest of the nation in the current economic crisis. In short, our economy has gone from the fastest growing in the nation to amongst the worst. Nevada, like the rest of the nation, is experiencing both a foreclosure problem and a credit availability crisis. In Nevada, the financial crisis is strongly related to the unavailability of capital. The lack of investment funds for projects has literally killed economic growth, while just a few years ago, this state led the nation in the creation of small businesses. Not only are many financial institutions not extending new credit, but they are also reducing or eliminating existing lines of credit for many customers, which only exacerbates the problem. Making capital available for institutions to loan to credit-worthy customers is an essential step in the right direction of turning this financial crisis around. Our nation banks are operating in a challenging economic environment, the severity of which is probably greatest in Nevada. A downturn in economic conditions often results in a weakening of the banking sector and an increase in bank failures. Nevada has seen the voluntary liquidation of 2 banks, the closure of 2 other banks, and the merger of 2 nationwide financial institutions into others. The declining real estate market of almost 30% in values, rising foreclosure to a level of the highest in the nation, slower economic growth, and unstable energy prices have both exposed and contributed to weaknesses in the portfolios of numerous Nevada banks. The industry now has to manage these risk exposures over an ever-weakening economy. Our job as regulators is to ensure that risks are identified in a timely manner and proactively managed to minimize destabilization of individual institutions, as well as the financial institutions industry as a whole. Nevada, particularly southern Nevada, has 2 major economic engines, gaming and real estate development. The overall economy has dampened gaming, and the mortgage crisis has stagnated real estate development with huge inventories of foreclosed properties. State-chartered banks in Nevada are being affected by these circumstances indirectly, but significantly. Most Nevada community banks do not originate much, if any, residential real estate mortgage loans. If they do, they are not held in portfolio in any significant amounts. However, the mortgage crisis has begun to spill over into the commercial real estate market, which Nevada community banks specialize in with small to medium-sized businesses. As residential real estate values have declined, so have commercial real estate values, specifically in the acquisition and development categories. If there are no residential rooftops going up, supporting commercial development of grocery stores, retail strip malls, etc., do not go up either. This has led to increasing non-performance in substantial segments of Nevada community bank loan portfolios. The need for...
If I could just ask you to wrap up so that we can be sure we hear all 3 people.
Certainly.
I'm sorry how fast 5 minutes goes.
That's quite all right.
And we will, of course, have your entire statement in the record.
Thank you. With the announcement of the capital purchase plan, 27 of banks, state bank charters indicated their interest in applying. 9 of these have submitted applications. 2 applications have been forwarded to federal regulators in Washington, D.C. headquarters, and 2 applications have been forwarded and approved by the Treasury. To date, only 3 Nevada institutions have received any of the TARP funds, and that is from funds that were supplied to their multi-state, multi-bank holding companies. All the rest of those that have been submitted so far are primarily from privately or closely held institutions, which the Treasury Department has only just begun to entertain the approval process. It seems that the larger institutions have avoided poor examination ratings that would have vexed them from consideration because of timing. However, the smaller community banks have continued to deteriorate, putting them at a competitive and regulatory disadvantage to publicly traded institutions because they may no longer meet the federal regulatory definitions of a healthy institution.
Thank you very much, Mr. Burns. I appreciate it.
Yes.
Thank you. Mr. Uffelman?
Good morning. My name is Bill Uffelman. I'm President and CEO of the Nevada Bankers Association. Madam Chair, members of the panel, I appreciate the opportunity to testify on behalf of Nevada's bankers on the Troubled Asset Relief Program. I've been asked to focus on the health of the local banking system in the current financial climate, including bank lending to small businesses, and whether TARP has had a measurable effect on the community banking industry in Nevada. Nationally, the TARP program has served to calm the financial markets and does have promise to promote renewed economic growth. However, it's also a source of great frustration and uncertainty to many banks. George has commented on how few Nevada banks actually have seen the money. Much of the frustration and uncertainty is because of significant and numerous changes to the program and misperceptions that have resulted on the part of the press and the public. Overall, as you know, regulated banks were not the cause of the problem and have generally performed well. Not only did the regulated banks not cause the problem, they can be the primary solution to the problem, as both regulation and markets move towards the bank world. Investment banks, in effect, are no more. They are all becoming bank holding companies with substantially reduced leverage opportunities and with much stricter regulation. In general, banks across Nevada did not make toxic subprime loans. They're strongly capitalized and ready to lend, but they cannot do so if misguided policies increase their regulatory costs and provide disincentives to lend. Banks already face significantly higher costs from deposit insurance premiums. They're almost double now what they were in the past. And banks are already receiving contradictory government signals about lending, being told to use capital to make new loans, and in some cases being told by bank examiners not to because the risk is too great. As you all probably recall, banks loan from deposits. You don't lend out your capital. The capital is there to support the lending, but it in fact is not to be or shouldn't be the source of the loans. There's a broad consensus that the crisis grew out of a housing bubble fed by mortgage loans that never should have been made, which were securitized and sold to investors who did not properly analyze or understand the risk. Excess leverage on Wall Street and other financial centers greatly exacerbated the crisis. The impact on the economy of the dysfunctional housing market is very evident in Las Vegas and in northern Nevada. The dramatic reduction in new home construction has hit the construction development lending, bringing to a virtual halt. Banks in both areas have also been hit by the decline in commercial real estate development, which typically lags behind residential construction. These impacts are further exacerbated in Las Vegas by the decline in retailing, tourism, and gaming. In northern Nevada, declines in manufacturing are also contributing to the decline of their economy. Despite it all, banks in Nevada stand ready to lend to qualified borrowers. However, it's more difficult for potential borrowers to qualify because of tightened credit requirements. At the same time, because of the economic slowdown, potential borrowers are not stepping forward to ask for loans. They have hunkered down to wait and see what the future holds. A banker at a large bank commented to me that in the old days they might have funded 7 deals out of 10 that were presented. Now they're only funding 3 or 4. Some of the other deals are referred to smaller community banks where they might obtain funding, while many wither on the vine. To many bankers, the implementation of TARP has been frustrating. To date, nationally, only about 50 banks have received capital infusions. In Nevada, less than a handful. As George has pointed out, 2 community banks have qualified for the capital purchase program and received funds. This is due to Treasury's phased implementation program. The program was open to the publicly traded banks in mid-October, to small privately held banks in mid-November. Guidelines for mutual banks, sub-S banks, and others that have no way to issue preferred stock have not been issued. My current chairwoman, she actually received the application forms on Thursday. She has to decide whether to convert her bank from a sub-S to a C so they can even proceed with the process. As Treasury moves forward, it should assure that TARP will allow all healthy banks, regardless of their corporate structure or charter type, to participate in the CPP. Treasury should also ensure that sufficient money remains to fully fund the CPP for community banks accepted into the program. It would be most unfair and result in competitive inequality for the community bank program not to be fully funded. Because the TARP funds have not really reached most of Nevada's community banks, I cannot say that it has a measurable effect on community banking. To the extent that most community banks have not yet had the opportunity to participate, they are at a disadvantage when competing with banks that have received TARP funds. Nevada banks continue to lend, and the TARP can help to further stimulate expanded banking service by healthy banks. As the economy starts to grow, the growth will be stunted if adequate credit is not available. Experience has shown in previous economic slowdowns it is the banks that end up providing most of the needed credit to support a recovery. Banks are anxious to meet the credit needs of businesses and consumers, and we know that such capital is vital to an economic recovery in communities large and small across Nevada and the country. Thank you. I have also provided the panel with an article that was in the Review Journal yesterday. It's a Associated Press article, Small Banks Rating for Rescue Funds. It seemed very on point. I could have read you the article rather than constructing something myself.
Thank you very much, Mr. Uffelman. Dr. Schwer.
Thank you. Madam Chair, members of the panel, thank you for the opportunity to testify this morning. I will be focusing on the economic conditions surrounding the state of Nevada, but will be making most references with respect to Las Vegas. But conditions in Las Vegas are pretty much matched by what is going on in our sister city to the north in Reno. Las Vegas represents 71% of the population of the state of Nevada and a population of slightly less than 2 million people here locally. There was a myth that was mentioned earlier about the southern Nevada economy, that it was decoupled from the national economy. That myth has been destroyed very clearly. But the myth was based upon 25 years of growth and expansion with a population growth rate in excess of 5% per year. And that compares with a national rate of 1% per year. Last year, we lost a population of near 10,000 people, and that turns into roughly 4,000 additional vacant homes added to the excess supply that we currently have. Looking at the composition of the economy, it is an economy that very much looks like the Michigan economy in the sense that it is concentrated in one industry. The location quotient, the measure that economists use to evaluate economic concentration, shows that in hotels and accommodations we're 17 times the national average, and autos in Michigan is somewhere around 12 or 13%. Over this rapid period of expansion of the last 25 years, housing prices in southern Nevada until 2003 remained at or near the national level, with very little price variation. So our economy was growing and providing housing, but it was not in a bubble situation. In 2003, we saw a change. In 2003, we saw that housing prices began to jump, and within a period of 1 year, housing prices had rose more than 50%. The cause of that is many components that are associated with speculative behavior. I will note only one, and that was on television. You could follow the get-rich retail real estate seminars, take out your mortgage equity, withdraw it, and invest in Las Vegas and get rich. We've also had others that followed on, seeing an economic opportunity, that were inexperienced, that added to the economic difficulty associated with the price increases. Housing price increases peaked in 2006 and have been going down ever since. I've included the most recent information in graphic form, the Case-Shiller Price Index for Las Vegas. Housing prices are now returning to the levels that they were prior to the peak, but nobody is buying other than investors. Overall, the economy slowed. I would note that we did not enter a recession here in southern Nevada until October. The economy peaked in October of 2007. So we went for over a year with minimal impacts, even though real estate and residential construction were heavily hit. What happened there is we had workers moving out of residential construction to construction jobs on the Strip. If it had not been for the credit crisis of 2007 and the associated difficulties thereafter, we may have got through that economic downturn without the severity that we now see. The Las Vegas economy is now one in which unemployment rates are rising. As noted, our unemployment rate has remained above the national rate by 1% and continuing to increase. We have every reason to believe that the economy, its unemployment rate will peak next year and could well be at the 10% level. We've also included a very important point of the risk during this period, and that is that the 50% of homeowners in the state of Nevada have negative mortgage equity, and that is a great risk going forward if the economy does not pick up. The housing problems focused in three key areas: price, for which we've made some progress locally; foreclosures, which continue to be a problem, an increasing problem; and jobs. And we're seeing on those last two that our economy is suffering significantly. So in conclusion, what we've seen is that credit has dried up. We had a housing bubble. We've seen flight to safety, and we anticipate that will be further problems here, a serious problem, and that we face significant risk going ahead, and that risk will depend very much on how the national economy performs over the next year. Thank you for your time and your attention.
Thank you, Dr. Schwer. If you all would remain for just a minute, we have a few questions, and I'm going to start with Mr. Neiman.
Thank you. As you all referenced, the Treasury has two programs in implementing its under the TARP. One is directed toward systemically significant failing institutions. The other toward healthy institutions, and that's where the bulk of the money has gone to, the capital purchase program. With respect to the capital purchase program, I'm interested in your views on the effectiveness of a strategy that invests taxpayers' money into only healthy banks, the term viable, without any additional assistance, and investment in banks without any restrictions on or requirements that money be downstreamed. I think Mr. Burns referenced the fact that there is no requirement that money invested at the holding company level be downstreamed to individual banks, as well as no restrictions or requirements regarding the use of the funds. And this is really one of the critical questions that we are dealing with. And I like the perspective of both the fact of any of the members of the panel that would like to comment.
If the capital purchase program continues to be orchestrated the way that it has been so far in its short existence, I believe that it's going to lead to further concentration of banking in Nevada, where over 80% of the market is already controlled by 3 national banks. This is because as the smaller banks have taken in longer and longer to be able to apply for and possibly receive these capital purchase plan funds, their exam ratings are deteriorating, and they're now being tagged as non-healthy banks. Whereas if this program had moved faster or sooner, or further consideration could be given to them regardless of what their most recent ratings are and so forth, there's sustainability there over the long run.
So the use of the capital into larger banks, the likely use of those funds will be for acquisitions of other banks, further consolidating the market.
Exactly. One of the few banks in the state that has received the funds from their holding company received over $140 million. They just recently announced that they're using $77 million of that in order to write off their bad security investments. That is not contributing to lending nor the stabilization of the system.
Last week when I was invited to appear before this panel, I went out to I went to my board and several of my other members, among them a small community bank. I want to quote something that he wrote back to me. The FDIC, FID just left here yesterday. George, forget what bank you were at. We've been impacted with the real estate and economic issues much the same as everyone else. They are just plain overreacting in favor of protecting the FDIC to the detriment of the consumers they are chartered to protect. They talk out of both sides of their mouths and are unquestionably on a mission to take some banks down regardless of their viability, their real viability. I will undoubtedly come under some sort of regulatory action, just not sure which one for now. The TARP program really needs to have its name changed, and I can think a number of good names since they have yet to touch a toxic asset by way of a loan purchase or stock purchase. I'll skip a couple other comments here. All the while, community banks like ours are left hanging in the wind and due to our deteriorated condition caused by the economic downturn excluded from eligibility for the CPP. It's just ridiculous, and I hope that the idea that community banks didn't cause the problem and are affected by it are being dismissed as bad investments. The FDIC has taken all this effectively discourages banks from taking any risk due to the fear of being downgraded and subjected to harsh treatment as they continue to protect the bank insurance fund. Since everyone knows the government will step in to bolster the fund, I think they're tossing out the baby with the bathwater. Now that you've heard it, I'm buried at this point working on an action plan to refocus this bank in a fashion where we're stingy lenders, or not lenders at all, and will only grow our loan portfolios at a rate commensurate with our core deposit growth. That won't go a long way towards encouraging the banking industry to begin lending again.
Mr. Silvers.
First, I want to thank all three panel members. I thought that the testimony was extremely valuable and candid. And as someone who just got off a plane from the East Coast this morning, it was worth my while just to hear the three of you outline the conditions. I'm really grateful. I want to ask several questions that really follow up on Richard's inquiry, which I think, as he indicated, is central to an aspect, at least, of our work. And let me pose a series of questions to you all. You maybe pick which you want to answer. We have met with the Treasury Department, and we have been present and reviewed much of what they've said about what they are doing. And they repeat, and we've queried them about this, and we've queried the Federal Reserve about this, that their sole decision criteria in the capital purchase program is whether a bank is healthy absent the capital infusion. That's all that they look at. All right. I'm curious if any of you have a response or an evaluation of the accuracy of that assertion.
Can I add the appropriateness? Is that what the test should be, right, as to the use of those capital injections?
With that addition, my second question to you really comes off of some of the comments in Mr. Elfelman's written testimony, where you discuss the quandary, the problem faced by banks contemplating requesting TARP money, the perception how potential depositors will perceive it, how stockholders will perceive it, a sort of set of game theory problems. Will a bank be perceived as being weaker for asking for money or stronger? And this, of course, interacts with the criteria, right? If the sole decision criteria is are you healthy or not, it's kind of a question you may not want to ask for fear of the answer. My question, though, is a kind of one step up, which is, does that set of quandaries that you laid out, which seem like a sort of no-win set of propositions for banks thinking about this, does that suggest that maybe we ought to reconceptualize the way in which the whole capital purchase program works, and perhaps, for example, give money to everyone? Right, so that it's not you don't ask, you just get it, unless, of course, you really can't, you really are non-viable, in which case you ought to be closed or sold off. Third question, and this is very brief. The Congresswoman and the Congresswoman-elect talked a great deal about the problem of mortgage restructurings. Each of you in your testimony alluded to the very high foreclosure rates. I'm curious as to what steps are being taken here to address mortgage restructurings by the financial institutions community, and what steps would be helpful for the Treasury to take under TARP in that regard.
So, a combination of questions there. Perhaps we'll start at the other end this time, if that's all right, Dr. Schwer.
Well, I'd like to come back perhaps to the first one and offer some explanation of perhaps what the Fed is doing. And the sense of question and the evaluation of banks is always that of solvency versus liquidity. And the deep abiding concern in the financial regulators is the question of solvency and the question of bank runs. And I would suggest that it is in the DNA of bank regulators not to use the word solvency. They're very much concerned about liquidity. So I think that perhaps reflects some of the comments that they may have made. With respect to structuring mortgage programs, I think it's particularly important to note the magnitude of the problem that we face. I realize that there are questions about how to do that, but waiting a long period of time to figure it out in some way may well result in the problem having grown to great magnitude. There is a question of getting it done and getting it done now.
Do you think it's important in thinking about this, how much attention should we pay to the question of whether some, unquote, undeserving people may receive aid if we act?
Well, I realize that there is always the question of equity of who gets what. That is the current debate about the distinction between the money that's being used for Wall Street and the money that's being used for Main Street. There is the question of bailing out the banking industry versus the automobile industry. So that equity issue is always in front. Standing and having a long debate on who wins and who loses runs contrary to getting the nation's economy back in order. So we need to be moving forward from my perspective.
Mr. Hoffman, would you like to respond to the questions?
If I could keep them all
I
straight.
hope you took good notes, sir.
I did want to comment. Fannie and Freddie, before their failure and their preferred and other their stock and the impact, it did have an impact on at least one Nevada community bank that I'm aware of. So immediately, the day before, you're being encouraged, put your money in Fannie and Freddie, can't lose, by the regulators. You do, and guess what? It's no longer basically of value. So your capitalization is down. Mark to market. In the midst of all of the Treasury process over that weekend, at the same time, we had people in the banking industry working on the mark to market issue. Again, a kind of a double whammy. I'll comment on the mortgage restructuring. As I said before, the banks that I represent, in effect, they got excluded from the mortgage game. I mean, the larger banks, that had a mortgage division, that because they, were in the mortgage business, they now are frequently servicers for a number of investors for those mortgage-backed securities. So they have a bigger portfolio to manage. But in fact, I mean, if you go out here, as was commented before, a community bank in Las Vegas, a community bank in Northern Nevada, a minimal number of mortgage loans, and frequently packaged up and sold upstream. But the whole servicing industry, yesterday afternoon I was on an extended phone call with people from all over the country in the servicing industry, talking about servicing-related issues. For whatever reason, I have become their spokesperson. The servicing companies that you used to have that collection side that made all the calls, those people are now becoming workout specialists, and they've added bodies. But again, how many thousand properties are we talking about? And the other experience that time and time again we're reminded, as many as half of the loans that are in default in this valley, the people will not return a phone call. They won't respond to the letter. They've, in effect, thrown their hands up and walked away. Well, foreclosure in Nevada, typically non-judicial. After typical, you've missed payments for 3 months, I file a letter called a Notice of Default and Intent to Sell. That's a 90-day letter. Sometime in that 90 days, we'd sure hope you would call home and ask about, can we make an arrangement? At the end of that 90 days, I then have a 21-day notice of sale. You still have an opportunity to work it out. After the sale at the courthouse steps, whoever the purchaser is, they basically have a 3-day delay before there is an eviction. So in that process, you've missed payments for 90 days, you've had the notice of default for 90 days, 21, you start adding it up. We're talking about 7 and 8 months before there's that final moment that the locks get changed on the door and the new owner, whoever they are, takes over. Maybe the institution got it back, maybe they didn't. But the net outcome of all of that is somewhere between 40 and 50% of the people who are involved in that, they haven't talked to their lender at any time. It's very discouraging. The homeowners association are upset with the lenders. The lender doesn't own the home until the end, and it's very difficult to deal with. So yes, we are working at it. There are more people available to do the workouts, but it's a very tough situation.
Thank you. And Mr. Burns, if we could just have a short answer. We're going to be running a little bit late, but we would like to hear from you on these questions.
To generally answer all of the 3 questions that you asked, and stuff, it is indeed the case that for the first time in history we are seeing banks fail not due to a lack of capital, but due to a lack of liquidity of that capital. And that's why the capital purchase plan is so important as far as providing capital to institutions so that they can loosen up the funds and gain that liquidity. It seems to become a matter of too big to fail versus too small to matter. The larger banks whose actual viability is probably more in doubt than small community banks are being infused. The smaller community banks are not.
Can I just ask you, do we have time?
We actually would be rude to our next panel. So I'm going to play the discipline of the chair here. I want to thank our first panel very much for coming. As I said, your remarks will be posted in full. We appreciate the time that you've taken, and the first panel is excused. Thank you. I'd now like to invite our second panel of witnesses to come down. We're ready to begin the second panel. I'm pleased to welcome our second panel of witnesses. We are joined by Gail Burks, who is President and CEO of Nevada Fair Housing, Inc., by Julie Murray, who is CEO of Three Square, a local community food bank, by Danny Thompson, who is Executive Secretary Treasurer of the Nevada AFL-CIO, and by Alfred Estrada, who is a Clark County resident who will share his personal story of the effects of the foreclosure crisis. Thank you all for being here today. As I asked of our first panel, please limit your oral remarks to 5 minutes. Your full written statements will be part of the official record. Ms. Burks, could we begin with you?
Thank you, Madam Chair, members of the committee, for the opportunity to make comment today. I have been asked to focus on the role of lenders in the foreclosure crisis and the prevalence of foreclosure victims and the impact on those victims. Is that better? I've been asked to focus on the role of lenders in the foreclosure crisis and the impact on victims. Nevada Fair Housing Center is a nonprofit. We've served the Valley since 1995, and much of our work involves housing and consumer issues. Over the last 2 years, we've seen a huge increase in our caseload for foreclosure prevention. Currently, on average, we are servicing about 600 calls and internet inquiries per day for foreclosure assistance. In terms of the lender role, in the Nevada community, advocates warned the local government officials as well as public officials about the increase in predatory lending in 2001. As we begin to see what we referred to as predatory lending, we saw an increase in fees, a decrease in retail originations, an increase in loan purchases, and a decrease in the use of such things as down payment assistance, FHA loans, and fee-for-service type work that literally represented services provided. As this increased, we saw a transition from predatory lending to subprime lending. With that, we mean consumers who could have received better loans receiving what we consider to be toxic loans or subprime loans. So how, in effect, did that work? In looking at actual data and case files in some of the communities that have been hit the hardest by the foreclosure, over 97% of the consumers that received adjusted rate, subprime loans, interest-only loans, or Alt-A loans had credit scores of 640 or greater and could have received a traditional conventional loan or even qualified for an FHA loan. As the increase in the subprime market expanded and the decrease of consumers receiving legitimate loans, we also saw an increase in foreclosure. Now, many of the national reports and studies that have been broadcast in the news have done what we call blaming the victim, or literally put the economic crisis on the backs of low-income consumers, stating that they caused the mortgage market to fail. This is not true. Many of the consumers that we see on a day-to-day basis are consumers who could have received better loans. The clients that we see are broken down into those who have a delinquency, meaning 30 days or less, those who have received a notice of default, meaning 90 days or more, and those who have actually received a sale date. Given the opportunity, many of these loans could be modified because the consumers could afford the homes. Now, earlier it was stated that 50% of those in foreclosure don't talk to their lender. What was not stated is that many of the consumers have attempted to contact their servicer to receive help, but because of all of the different programs that are available, the loans are not getting modified without some sort of intervention and assistance on behalf of the consumers. The other thing that we are seeing in terms of the foreclosure crisis is not enough sufficient initiatives to actually address consumer issues. All real estate is local. With the inability to modify loans or to obtain direct assistance or funding to modify those loans or to purchase those loans, these loans are actually going into foreclosure. That's also leading to another type of scam. Consumers are being inundated with requests to pay for foreclosure prevention services. In some instances, consumers have paid upwards of $4,000 to scammers to modify loans, only to find that the foreclosure has not been stopped. The top funds have not increased lending. Indeed, many lenders have changed their mortgage conventional products. So today, you have to have, on average, a 680 to a 720 credit score, and 75% of that loan will be financed, whereas the other 25% must come from money from your pocket. In order to make TARP effective, we have to give consumers some relief. We have to make modifications mandatory versus voluntary, and we have to ensure consumers that there is legitimate assistance to help with the foreclosure crisis.
Thank you, Ms. Brooks. Mr. Thompson.
Thank you. Thank you, Madam Chairwoman. And members of the committee, it's a pleasure to be here today. I think the previous speakers have pretty well laid out what happened here, in that we had this massive housing bubble and a move by everyone to make money quick. Let me tell you, during that period of time, I was going to buy a rental property to show you how bad this was. I had found one that was right, that I could afford and make enough money in the rent. And when I went to make the offer on the home, the person selling the home told me, well, no, that's not enough. You have to offer more, because this week the prices went up. The prices went up so quickly, and there was such a move by people to get in on this get-rich scheme, if you will, that the lenders made loans that normally they wouldn't make. I have friends who got ARM loans that they didn't fully understand. Interest-only ARM loans on a $700,000 home that and told by the lender that, well, don't worry if the rates go up beyond, because there's no way they could afford that home. If the rates go up, you'll simply refinance. And then we come to where we are today, and you couldn't refinance if you had to. Today, there are over 30,000 foreclosures in Clark County. And one of the problems, quite honestly, is that 50% of the people that hold mortgages owe more on the mortgage than the home is worth. Now, that's a direct result of the bubble popping, but it's also a lot of those people are her clients, where they now have those ARMs and those interest-only ARMs come due, and as they get readjusted, they find themselves in a situation that is impossible. And so many of them simply walk away. When you have a $450,000 house, that the house right across the street is worth $200,000, that's what's happening. Some of them literally walk away, and some of them go and turn the keys in. Whether the stimulus has helped individuals, I don't know of any help that is filtered down to homeowners. I do know, though, that the lack of regulation or the lack of enforcement of existing regulation on some of these mortgage companies is something that certainly needs some scrutiny, because, like I say, I know people that have loans that ended up with an adjustable rate mortgage that they didn't fully understand that that's what it was. Whose fault is that? I don't know. But I can tell you that the result of that has put Nevada as a state in a place where we've never been before. Right now, on the Las Vegas Strip, we have the largest privately funded construction job in the world. There are approximately 10,000 workers on that job. And Nevada's economy is so dependent on a single source in that almost 50% of all the money in the state budget comes from a single source. And so I can tell you what the fix is not. The fix is not to take away wages. The fix is not to take away pensions. The fix is not to take away health care of workers, because that's a rush to the bottom. And, I've heard so many people say, well, we need to, in fact, this legislative session, I'm in the fight of my life to protect public employees' pensions. That's not the fix. The fix, I think, is creating jobs and good-paying jobs and jobs that pay prevailing wages in the community that they're created will get us out of this mess. Thank you.
Ms. Murray.
Good morning, Chairwoman Warren and members of the Congressional Oversight Panel. My name is Julie Murray, and I serve as the CEO of the 3 Square Food Bank in Las Vegas, Nevada, and I am honored to have been invited to provide testimony today. My testimony follows that of housing and finance experts who have done an outstanding job discussing the economic conditions of our community and our state. My role in today's proceedings is to focus on what these numbers mean in terms of human lives and how the residents of our city and state are being affected and are suffering due to the downward trends in our economy. As you know, I run the 3 Square Food Bank, which started over a year ago at the inspiration of Eric Hilton, youngest son of Conrad Hilton, and numerous other think-outside-the-box leaders in this community who declared that it was not acceptable for people in our community to go hungry. As the newest member of Feeding America, we are proud to distribute food in Southern Nevada to over 211 nonprofit agency partners and faith-based groups, churches. We also provide weekend food bank bags to 120 schools with our Backpack for Kids program. Maslow's hierarchy of needs states that when looking at how a human being's needs are met on a pyramid, the basic needs of food and shelter are at the base of the pyramid, serving as the foundation. Once a person has these basic needs of food and shelter met, they are better equipped to excel in school, to maintain a job, and lead a productive life. When part of that foundation, the core, food and shelter, is absent or has crumbled, it makes it very difficult for a person to survive or exist. If I would have testified a year ago or even 6 months ago, I would have said that thousands of families in my home state are living paycheck to paycheck and are just one crisis away from disaster. However, I am sad that as I testify before you today, those thousands of families have had that one crisis occur. Due to the recession, they are now living their biggest fear, living without a paycheck. Our city, county, and state budgets are receiving double-digit cuts at a time when people are in most need of services. At the 3 Square Food Bank, we see the people affected by these statistics and these numbers every day. Let me give you 3 brief examples in the 5 minutes of my testimony. Number 1, children. Children facing hungry. In this Clark County School District here in Southern Nevada, nearly half of our children, 132,000, qualify for a free or reduced lunch meal, which means that a family of 4 makes less than $20,000 a year. Picture that, 5 out of 10 children crossing the crosswalk on their way to school who are struggling with hunger. When half of our children are suffering, we are living in a crisis mode. Thank you. Secondly, families in need. For every child in need, there are members of families struggling to make ends meet. Recently, while filling my gas at a gas station in Summerlin, Nevada, a car driven by a middle-aged man with 2 sweet little girls in the back seat pulled in next to me. The man approached me with an ashamed look on his face and said that he had never been out of work, but recently was laid off, lost his home, and could not afford gas or food for his family. My heart broke as the 2 little girls watched their dejected father beg for money. I gave him some cash and told him how to find a local food bank agency partner where he could receive free groceries. As Nevada's unemployment rate grows, such stories will only become more common all across the country. So in conclusion, I want to share with you that I testified before the Congressional Appropriations Committee last week, along with governors from Wisconsin, Vermont, and New Jersey, and an expert on higher ed. Congressman David Obey wanted the Congressional Appropriations Committee to hear testimony about how lives are being impacted, and I was delighted to be able to represent our state and share that with him. My input for that committee and my input for this committee is the same. When we are looking at ways to affect change, and when you are looking at the effectiveness of TARP, let me say that we have not seen any decreases in the demand for food or services from my food bank and from our 211 nonprofit agencies, partners, schools, and churches. In fact, as we wind down our year, each week brings huge increases in demand for food and longer lines of people who need food at our agency and nonprofit agency partners. My recommendation is that we all work together, and in the final conclusion is I want to share with you that, as Damon Silver said in his opening remarks, we're all woven in this together. And Richard Neiman said, only so much can be done at the state level. And all of you are right. We have to work together. My food bank, service providers, cities, counties, states, and the federal government must communicate and be effective. It is a sad day when a child writes to Santa that all he or she wants for Christmas is food. This recession is frightening. It's impacting us all. People are suffering, and I thank you for coming to our state to hear about how things are going. Thank you.
Thank you, Ms. Murray. Now, Mr. Estrada, if you could wait for just a minute, we're going to hear, I believe, from Senator Reid, who's going to join us. I think politicians move slowly. Senator Reid, on behalf of Mr. Neiman and Mr. Silvers and myself, the Congressional Oversight Panel, we want to welcome you here today and offer a special word of thanks because without your insistence, this panel would not exist and certainly would not be in Nevada today. So we welcome your thoughts.
Madam Chair, I appreciate very much all of you being here in Las Vegas, but more importantly, thank you very much for taking this assignment. This is an extracurricular activity that you all didn't have time to do, but you're all uniquely situated to help the American people work their way through the issues that they have, which are significant.
Senator, could you move the mic just a little bit closer now that you've finished those kind words?
It's good over the years. I haven't developed a complex because people always tell me I don't talk loud enough. And maybe I do have a complex, you don't know. For those who are listening, I had the unique opportunity to appoint the chair, Elizabeth Warren, and I appreciate your taking this. I worked with Speaker Pelosi, Mr. Silver, to get you on this board, and it's really is a very, very important job that each of you have. I can't think of a more appropriate place in the country than Las Vegas to hold this hearing. No place can demonstrate more the struggles that communities across the country are facing as we work our way through one of the most difficult economic recessions in our entire nation's history. I'm confident this hearing will provide the Oversight Board important information and insights into the economic crisis to help guide its work in Washington. Before the election, we passed the Economic Stabilization Act, which created the Troubled Asset Relief Program, or as we all refer to it, TARP. In acting, Congress believed that working with the administration and the Federal Reserve, that there could be an ad hoc approach to rescuing important financial institutions that at the time wasn't working at all. And we felt a comprehensive legislative solution was needed. We all believed, and Congress certainly was part of that belief, that the financial system had to be stabilized before a broader economic recovery could follow. The Bush administration initially believed that they would do this by using TARP to purchase from banks troubled assets, which consisted mainly of mortgage-backed securities or mortgages. Now, I'd never heard of an illiquid asset, but that's what Bernanke and Paulson kept referring to, these illiquid assets, these bad loans. These illiquid assets had been rapidly declining in value due to the housing crisis and were causing many institutions to suffer enormous losses. Soon after the law was passed, Secretary Paulson concluded that this approach was too complicated and would take too much time and, frankly, too much money. So Treasury shifted gears and began buying preferred stock in the nation's largest banks as a way to inject capital into these firms and hopefully into the country's financial problems. This capital could be used to help absorb expected losses on real estate and related securities or mortgages, and also could be used to provide funds for lending, which we know is critical to economic growth. So far, we know that at least $335 billion have been allocated under TARP. Yet, as the economy continues to deteriorate, foreclosures increase, and credit continues to contract, many Nevadans wonder whether TARP is being used appropriately. All America shares this. I do. I see two problems with how TARP has been implemented so far. First, most of the big banks that receive capital funding through TARP, some $225 billion, were healthy and should be using the new capital for lending, and they're not. Instead, these firms appear to be contracting their lending activity just when business and consumers across the country need access to credit the most. This lending contraction exacerbates our country's economic troubles. And if there's anything that I want to make as a point today, is that these banks have to loosen their grasp of stopping people from borrowing anything. Businesses have been ongoing for years and years with good credit ratings. Can't borrow enough to keep their businesses going. People can't buy cars. I met with a bank president here in Las Vegas yesterday, president of one of the 100 largest banks in America. He said it's unbelievable what is happening as far as his bank. People can't get, their credit ratings can be very high. They can't get approval to borrow money for a car loan. And that, as you know, I've spoken to car dealers. The few cars they have somebody wants to buy a car, they can't get it financed. So $225 billion given to these big banks has not helped the problem at all, and that's the way it should. Shouldn't be that way. I took the liberty yesterday to call 3 large financial institutions. What's going on? And they all had the same answer. We're working on it. Well, I would suggest they get a new work crew because it's just not helping at all. Underwriting standards became too shoddy before the housing bubble. We all know that. But I believe the pendulum now has swung too far in the other direction. I hear from too many constituents, parents, small business owners, or business leaders that need capital but can't get it because it's either unavailable or far too expensive. The banks that receive TARP funds have a unique responsibility due to the fact that American taxpayers now have an ownership stake in these banks. All of us here who pay taxes are shareholders of those banks. We can't force them, but for the good of the country, the banks should be putting their TARP funds to use and lending where safely possible. I don't know if this is true. You can find out that some of these big banks are loaning money to countries in the Middle East. To business propositions in the Middle East, but nothing here in America. And I would hope you would follow up on that. Second, despite Congress's clear intent that TARP be used to stem foreclosures. So far, no TARP funds have been used for that purpose. Meanwhile, the number of foreclosures increases by day, especially here in Nevada. Some of the witnesses here, like Gail Berg, can explain firsthand if she hasn't already the scope of Nevada's foreclosure problem and the tremendous strain it brings to working families and entire neighborhoods. If we don't confront the problem here more aggressively, experts predict we could see another up to 2 million foreclosures in the next 2 years. Oscar Goodman and I went to the #1 place in the city of Las Vegas for foreclosures. The average home in the area was 8 years old. It was a very nice neighborhood. People have the idea these foreclosures are taking place in slums. They're not. The #1 foreclosure district in Las Vegas, neighborhood I should say, in Las Vegas is a very nice neighborhood. But part of it was exacerbated by the virtue of the fact that here in Nevada we had a lot of homes that were bought for speculative purposes, not to live in, and that made things worse. My colleagues and I in Congress know that strong oversight on the Treasury Secretary was critical, given the large funds at stake. The Oversight Board is just one of several tools included in the legislation to hold the Treasury Secretary accountable to the taxpayers for fulfilling the objectives of TARP. While I had some role in the makeup of this board, everyone should be reminded that this board is independent from Congress. This board will be a reliable resource, however, to Congress and the public and this administration and the Obama administration as we learn from you how the Treasury program is performing and whether it's helping put our country's financial system and economy back on track. And I would say to you, Mr. Neiman, I'm going to go out in just a minute and speak to my #1 pal on the telephone. Schumer and I talk, Senator Schumer of New York talk and I several times a day, and he said only nice things about you a few minutes ago. Thank you very much.
Thank you, Senator. We appreciate your comment.
Could I be excused?
You may be excused, Senator.
Glad to escape this difficult cross-examination.
Thank you, sir. Mr. Thompson, would you like to rejoin us? Mr. Estrada, it was a wait. We appreciate your patience, and now it's time for your statement. Please, sir.
Good morning. My name is Alfred Estrada, and I was referred to you guys by my realtor, who is Leslie and Miss Moore at Executive Direct Realty. I'm going to tell you a little story about what happened to me, okay? What happened was that my house, I fell behind on my payments, okay? The house doubled in price, like this gentleman was saying, is that the house is doubled in price, so the amount of money that I owed on my house was not what it was worth anymore. So I had found another buyer to purchase the house for me, right? And this is when I met up with my realtors, and I had asked them, I says, I want to short sale the house to a family friend of mine so that I can stay in the house. I have 2 little daughters, and I live in a house where I would never need to live in any other home in my life. Okay, this is my dream house because I can open my garage door and see my daughters playing right directly across the street because that's where their school is at. Okay, and what had happened was that my mortgage company, they did everything what they were supposed to do. My wife, she worked on it for 2-3 weeks, always on the phone. We had sent a bid in for the house for a fair rate of $75,000 for the house. All the houses had lost all their equity in the homes. Okay, so this was with Wells Fargo Bank, and what they had told us was that they wanted $98,000 for the house. Okay, so I called back my buyer and I told him, I said, listen, this is what they want, and then we can get the house back. Because the one part that I never wanted to do was to leave the house. Okay, well, we did everything that they asked for. We gave them a new bid, the money that they wanted. They told us that if you give us this amount, the house is yours. So after we did everything we were supposed to do, for 2 weeks, we couldn't get in touch with anybody. And then about another week or two down the road, and we find out that our house was sold at auction. I had a realtor come to my house and tell me that I had to move out of my house because they had no record pretty much of none of the things that was being done as far as the new bid for the home with our first mortgage company. So at the end, they tell me that I have 14 days to get my children out of the house and take them out of the house that's their home, really. And so the gentleman tells me that he's going to pay me $500 up to, well, first $1,500 he was going to pay me for something called keys money, cash for keys, which meant, because my wife, she was working for a lady that was into foreclosed homes, and she was cleaning the homes. And so I had been with her, and I had seen some of the homes that people that are so distraught they're losing their homes, or they're just upset, and they're tearing these houses apart, which is bringing the value down even more. And I told the gentleman, I said, look, I says, that's not our intention. I says, my intention is this, is that on the day that you tell me that you are going to put the house back up for sale, I want to be the first person that you call so that I can have what should have been done in the beginning get finished so that I can move back into my home. The thing, what really amazed me is that the $98,000 that the bank said that they wanted for the house, well, they sold the house for $85,000 in auction. So they actually lost money. So now Wells Fargo has the house, and now we've had to leave the home. I live in an apartment right around the corner from my house because I have 5 and 6-year-old daughters. My 6-year-old came home the other day with a full sheet of paper with all of her friends' names on it, and she told me that these were the people that were going to miss her because we were going to have to be moving. And I told my daughter, I said, I don't care if I have to live in a van. I said, you're still going to be able to go to this school. I'm trusting in God that we're going to be able to be back into this home again. But this is what had happened to us. We had the money to buy the house. It wasn't supposed to go into foreclosure. And 4 or 5 days later, they sold it at auction for a reduced price.
Mr. Strong, do you have any idea why this happened?
I have no idea. We did everything we were supposed to do. My realtors put in the bid for the home. They were dealing with the mortgage company, this and that. They sent back saying that they didn't want the first bid, that they wanted this amount of money, and they would sell the house to us. So that's what we did. We gave them everything that they wanted. And in the end, they threw me and my family out of our house.
This is often, unfortunately, a common story where banks are not moving these short sales along. And I assume when you had that offer to purchase that home at that price, they were going to allow you to remain in that house either through a rental or a loan, personal loan to you?
Right. We were going to rent the house from the buyer.
Right. And this is something, an area that has to be addressed in order to get banks to move that along. Because as you see, you're not benefiting. And the bank is not benefiting,
no.
So it's a lose-lose, and that
right.
really is. And I very much appreciate you bringing this one to our attention because it highlights a number of the problems in facing and dealing with an institution and the impact that it has on families. So I thank you very much for sharing that with us today.
Yes, sir. You're very welcome. Thank you.
I have 2 questions. First, I want to pose a question about foreclosures, and I think Mr. Strada's testimony suggests that foreclosures is kind of the first idea rather than the last. Right. And we in Washington have heard on a number of occasions from the Treasury Department, in the context of the Treasury Department implementing the TARP, the bailout, that what they are doing, that they're doing an enormous amount to prevent foreclosures on a voluntary basis. They have a program that they talk about called Hope Now, right? And they say that is the appropriate way to deal with foreclosures, is by voluntarily encouraging the banks that are receiving the hundreds of billions of dollars to work things out in just the, maybe not quite just the way they worked them out with Mr. Estrada, but that kind of idea. I'm interested in the panelists' observations about the effectiveness of this voluntary approach and what might be done alternatively, if that's not good enough, with what remains of the TARP money. Second question is for Mr. Thompson. There was a mention of the...
You have multiple chances to ask questions.
Oh, I do?
So
okay.
If you want to just ask one.
Then I'll ask one, I'll come back. Thank you.
Thank you. The Hope Now program is a program that uses a national toll-free number for consumers that need assistance to call in. The difficulty is it is impossible to truly diagnose a particular loan situation without looking at the case file, taking information from the client, and looking at the neighborhood at large. If you just tell the consumer to call the lender and request a modification, it doesn't work. You have to assist the consumer in calling the lender and show that lender how it's in the best interest of their investors and the consumer. How can they maximize net tangible benefit by keeping the client in that home? It's a lot of work, and on average, if you do it correctly, you will spend about 200 hours per case. It's a direct service. There's no way around it. It's like trying to diagnose your medical problem without running a test or without doing any blood work. It cannot be done. So all of what we have done in all of the voluntary initiatives, call a toll-free number, get it refinanced through FHA Secure, they don't address the fundamental problem. Look at, can the consumer afford the mortgage? Is it in your best interest to take a short sale? And make sure the paperwork goes through and is recorded so that there is no foreclosure. And then the last thing is different lenders, different servicers have different departments, and they don't talk to each other. It happens all the time that you're negotiating a deal and the foreclosure goes through. So then you have to start at the top, work down, and rescind that foreclosure.
Thank you. Mr. Burks, we, as you probably know, in New York are working with a number of other state banking departments and attorneys general in meeting with servicers on a regular basis. The data that we have collected continues to worsen and shows that 8 out of 10 seriously delinquent borrowers are in no stage of foreclosure mitigation. What are you seeing in terms of the largest obstacles? What's the greatest obstacles that you believe that the servicers are refusing to modify these? Is it the volume? Is it the staffing? Is it the fiduciary duty they assert that's owed to investors? What's it in your opinion that we need to the hurdle that we have to address?
It's a little bit of all three. The major thing is the people on the servicer end that answer the phone and talk to the consumer, and sometimes the same people that talk to the advocates have no authority to make a decision. If that servicer does not have full delegated authority, they cannot give you an answer on that modification. They have to go back to the investor, get permission, and then come back. And so you have to be able to sort of negotiate at a higher level, to go to the top to say, this is what we need to do, present an offer, and literally do counter offers back and forth. That's the main problem, that the people on the line don't have the ability to say yes.
One of the other criticisms is that this ad hoc basis of negotiation, it will never address the millions of foreclosures. Is there a systemic streamlined modification program out there that you support as an alternative to move these modifications forward?
Well, it's not out there yet, but we would support making it mandatory. There has to be some mandatory modifications in order to stabilize the market. It's not going to happen otherwise.
As I understand it, and I hope maybe other panelists will respond to this, as I understand it, there's been a dialogue about foreclosure moratorium here in this state. It's my understanding that the governor has asked the major servicers to voluntarily take on a moratorium. Am I correct in that?
That request has been made. It is unclear as to which servicers have agreed to do that and will do that. And so we advise consumers, please don't take a chance on voluntary moratorium.
All right. But now, to come back for a moment to the issue of what the Treasury has said. All right. As we have been providing financial institutions with hundreds of billions of dollars, right, we have been simultaneously saying that for homeowners such as Mr. Estrada, right, the solution is a negotiation, perhaps 200 hours, right, in which the ultimate power as to what to do, right, rests with the bank. Right? They can choose to act arbitrarily or they can choose not to. Right? It's not doesn't appear to be the government's business. Right? As far as I know, Mr. Estrada, have you received any money from the Treasury Department to assist you?
No. Not yet.
Now, there seems to be, it feels like there is some kind of difference in approach here, fundamentally. Right? The Treasury Department says to us, well, we are concerned that people who are undeserving might receive money. Now, perhaps we can request an application form for bank assistance and see if the question, are you deserving, is on the form someplace.
Some regulation that would be mandatory for these lenders to be more proactive with these people, and oftentimes people who can't tell you what their loan is. They don't know that they're in an arm. They don't know that it's going to be readjusted. But the potential, certainly in Clark County, where half of the people owe more than the house is worth, the potential there is disastrous. So if I were in the mortgage business, I would be more proactive in reaching out to those people, knowing that at any given moment they could walk away for a better deal somewhere else. I would be, and I don't think it's unreasonable for the government or the Treasury Department to require them by regulation to be more proactive in that they're getting the bailout money and seek out these people who, and it's easily identified. They know what their loans are and they know what the value is in the community. Seek them out and see if you can't make arrangements with them to keep them in the house.
There has been a deal between Citigroup, the Treasury Department, and the FDIC that in exchange for Citigroup received, I think it's $25 billion in the first set of monies for healthy banks. Then later on, when there were some issues at Citigroup, they received another $20 billion. In the context of that second infusion of cash, there was an agreement that Citigroup would implement the FDIC program for mortgage modifications. Now, the FDIC program is not a principal write-down program. It's a program that defers payments in certain respects, reschedules things to make the loan more attractive. Is it your view, Mr. Thompson or Ms. Burks, that perhaps ought to be across the board for people who receive this money? For banks who receive money from the Treasury Department?
I believe that.
Ms. Burks?
Yes.
All right, that's the sort of thing you're talking about. Ms. Murray, Mr. Estrada, you haven't had an opportunity to respond.
Yes, thank you. As we talk about 50% of the people who receive a foreclosure letter are not responding, I just want to remind all of us that oftentimes those same 50% of people are people who have lost their jobs, who don't have food, and are just trying to survive. So as we look at the ripple effect that comes from what you're here to investigate and how it flows through the system, if you lose your home, you lose your job, vice versa oftentimes, and you have no food, it's so important for us to get the core fixed so that people can stay in their homes, have jobs, have a healthy economy, and be able to have food. These are just the basic needs in life. So I wanted to, again, just talk about the human element in all of this. So thank you, Mr. Silvers.
In New York, the numbers are even worse. Over 90% of people who lose their homes through the foreclosure process, and we have a judicial process in New York, 90% of those individuals are lose their homes through a default, meaning they never show up. And that's why, and it's either because they don't think they give up hope, they don't understand the process, they don't know how to obtain an attorney, or they just think that there's no hope. So I think your point is so well taken, and why the focus has to be on not-for-profits who provide housing counselors, on legal aid to provide assistance on these complex issues involving negotiations, because individuals cannot be expected in anyone to understand the complexities. You even heard the senator talk about the complexity of these illiquid securities, and these contracts, these mortgage contracts, are even more complex. So I agree with you, and I really appreciate you putting a public face to these complex issues.
I'd like to ask in a different direction, as long as we're talking about mortgage modifications here. As I know you're well aware of at this point, it's possible for a family to declare bankruptcy and deal in effect with virtually every debt except the home mortgage. And so credit card debts can be written off, car loans can be written down. Indeed, mortgages can be written down on real estate if they're on vacation homes, if they're on rental property, if they're on business property. But for someone who lives in a home and is trying to save that home, there is currently no bankruptcy protection. One of the alternatives that Congress is currently considering would be to amend that portion of the bankruptcy laws so that bankruptcy is never a happy alternative, but it puts rights in the hands of the family, so that it would not be possible to ignore the phone calls. It would not be possible not to have someone on the phone to negotiate, so that these mortgages could be rewritten at least down to 100% of loan-to-value ratio and put people into 30-year fixed mortgages that would permit them to save their homes. I wonder if you could speak to the impact of that on not only how it would or would not be useful for families who are in trouble as a direct option for some families to go through bankruptcy, but perhaps more importantly, how it might change the structure of the negotiations if the consumer had the option available to the family to declare bankruptcy if nothing could be worked out consensually. Could anyone speak to that? Perhaps Ms. Burke should be appropriate.
Thank you. When the bankruptcy rules were changed, it became more difficult for consumers to file bankruptcy. And attempts have been made to get mandatory cram down and to look at using bankruptcy to stay the foreclosure. That would be very helpful if we could get that passed. Currently, when they file bankruptcy, if they don't litigate the underlying subprime mortgage issue, they cannot then go back again and address it. So once the main bankruptcy plan is put in place, guess what? The lender's running out, filing a motion to lift the stay to take the home anyway. So yes, we need the bankruptcy rules amended in order to help consumers address these issues.
I want to shift for a moment from mortgages to jobs, or in a way to jobs, but really I want to get at the heart of, I think, the reasons why Congress passed the Emergency Economic Stabilization Act, the TARP, the bailout, why this was passed and what Congress was trying to achieve, and what I believe the people at the Treasury Department are in good faith trying to achieve. Reference has been made to large commercial construction projects in southern Nevada, and particularly on the Strip, and to projects being canceled. There is an argument that it takes a while for money to flow down through the financial system to home mortgages, to cars, and so forth. Large commercial construction financing, which drives jobs, good jobs, to your point, Mr. Thompson. Large commercial construction financing moves very fast if people want to lend it. I was hoping to ask the prior panel this, but we have a structured time frame here. But, Mr. Thompson, I wondered if you might be able to enlighten us as to whether or not large commercial construction financing is flowing in southern Nevada or not. And if not, why not?
Well, I can tell you that right now we have the largest privately funded job in the world. When that job is over, and there are about 10,000 people on that one job, I don't know where those people are going to go to work. As a direct result of this financial crisis, builders, developers aren't able to get financing. We have Echelon, which is a massive project, coming out of the ground, and it's closed because it's not able to finance the project.
We're new in town. Tell us about it.
It's a resort development on the Las Vegas Strip. It's partially built and stopped in the middle of construction. It was in the early phases of construction, so there were only about 1,000 workers on that job, but they literally stopped the job because of the inability to get the financing. And so if you multiply that out times every job that I can think of that's either been canceled or put on hold or postponed, we are heading for some very tough times in Nevada specifically because we're so reliant on one source of income in the state that when they have hard times, we all have hard times. And so if you add the fact that now builders can't build and developers can't develop to just a general downturn in the economy, we are in real trouble here. And potentially this time next year, and I think you heard Dr. Schwer talk about unemployment numbers this time next year are going to be severe unless something changes. And unless something can be done to loosen up those lines of credit to businesses, we're going to have double-digit unemployment and an economy that's going to be very difficult.
Can I just get more specific with you for a moment?
Okay.
It became clear that the Treasury Department was going to infuse banks with substantial equity capital in mid-October. Now, of course, the mechanisms by which the money gets there are a little slower than that, but it became clear in mid-October. By mid-November, right, some of the largest banks had received that money. Those are the sorts of banks I would assume that would be potential funders for a project of the size of the Echelon project. Have you seen any indication, or are you aware of any indication among developers that that construction unions deal with, that there has been any increase in the availability of credit starting in mid-October, starting in mid-November?
Not to my knowledge, and I would tell you that the city center is actually saved by partially being funded from money from Dubai, but I don't see that happening. And as this thing continues to tighten around and people spend less money, and you can't get a financing on a car, so the cars aren't selling, it just at some point spins out of control.
We are hearing that across the country. In New York, that's traditionally been a very strong commercial development location. We are hearing that there is no money to any loan tied to real estate, that over $400 billion of commercial real estate loans are coming due and are going to need to be refinanced over the next number of years, and there are no banks there to talk about refinancing. So I appreciate you highlighting it from what it means for Nevada, but recognizing that this is going to be an issue that we are going to look at and address across the country, because these are some of the largest banks that are accepting these funds as capital, and as of now, we want to understand why. What are their lending standards with regard to large commercial construction development projects?
Mr. Neiman, I think Ms. Murray would also like to comment on this.
Thank you, Chairwoman Warren. Going back to Mr. Silver's comment, you recently mentioned unemployment, and you shifted the transition to that. Let me share with you in Nevada, we are currently at 7.6% unemployment rate, and you heard Dr. Schwer say we are on track for what could be 10% unemployment rate. And as you know, nationwide, traditionally, we've been a percentage point or more below national average for decades. So currently, if we have 5 out of every 10 children in school who need and qualify for a free lunch, or else they don't get food in a day, and we go from 7.6% unemployment rate to 10% unemployment rate, the numbers are going to skyrocket of kids who won't eat and won't have access to food. And so we're bracing for something of crisis proportion next year, when unemployment rate could go as high as double digits. So again, I come back to the importance of what you all are doing and what you're doing in listening to share with Congress the severity of the situation, and I thank you for that.
There's a point that I'd like to make that unrelated to the banking crisis, that I think when you talk about stimulating the economy, and certainly in this state, one of the things the federal government could do is to relax the need for matching funds for instance, highway construction is a match. If the government could put a moratorium on matching funds for public works projects for 2 years so that the state doesn't have to come up with that money, and yet they get the funds to build those projects, I think it will go a long way in creating jobs. Just this last year, we gave money back because we didn't have the matching funds to match for the particular program. And I think that's something the government can do immediately to help the economy.
Mr. Thompson, can I just ask, because this is one of the proposals on the table, not specifically for TARP, but in general, the idea of putting money directly back into the states overall, with the theory behind it that the states are well prepared to put this money to use, to put people into jobs, to rebuild infrastructure, and so on. Can you comment on this? Do you think this is a wise move, a foolish move? I'd be interested in your thoughts on this.
I can tell you, I served in the Nevada legislature for 10 years. Actually, I served with Shelley Berkeley and Dina Titus. But I can tell you, absolutely critically needed. The state is ready. For instance, I'm a commissioner in the High-Speed Train Commission to build a train from here, a maglev train from here to Anaheim, California. So much work has already been done on that job. If we just had some money, they could start construction soon. And in regards to matching funds, we've mapped out needs to widen I-15, to increase the freeways the work's already been done, but we don't have the money. And so by relaxing those matches and letting the states keep the money, you would create jobs overnight.
That's very helpful. Mr. Silvers?
Mr. Thompson, your comments, I think, go to my opening statement, which is that the real underlying problem here, which we need to be conscious of as we craft the TARP, as the TARP moves forward, is that we're not moving resources to productive uses, right? Enormous housing bubble, speculative boom here, but all around the country. Meanwhile, critical needs, the Congresswoman talked about energy and infrastructure, critical needs are unmet. Now, part of addressing that is the issue of moving public money. But part of the issue is, why is our private funds, why are our capital markets not funding productive processes and instead funding destructive speculation? Right? That is all over this. And the question of what should the Treasury Department and the Congress be doing in relationship to TARP to see to it that TARP moves us in the right direction, right, rather than in the wrong direction, right, rather than repeating this cycle of destructive and ultimately misleading financial booms, right, is, I think, right at the center of things. I would like to turn again, though, I think, we as a panel later this week are going to be meeting with the FDIC, and we hope to be meeting with Treasury again. We will have an opportunity to convey what we hear today to the people who are the decision makers, right? The people who will decide what to do with the TARP funds that remain, who will decide what sort of oversight there should be over institutions that have received money, that will decide what the rules will be for some of these programs that have been announced that involve, like, buying credit card paper or buying other sorts of paper. Right? There's more money involved here than I think any of us can properly grasp. Right? But this is an opportunity, and as our chair said, there are cameras outside for all of you who are here to be heard. But this is an opportunity, particularly for the four of you, to be heard, for us to be able to carry a direct message back. Right? And I particularly would like Ms. Murray and Mr. Estrada. This is your chance. Imagine Hank Paulson is sitting right here at this desk. What would you say?
If Hank Paulson were sitting at the desk, I would say that never in the history of our country has the challenges been so great. But then never has there been a greater opportunity for us to show how strong we are as a country. We are the United States of America. We have to, and we will be able to get this under control. But it starts with the strength of the financial communities and unemployment. Because as a food bank, I can do all that we can do to keep up with food. But if people don't have jobs, and if there's not strength in the financial markets, we're only being reactive. And that it's so important to be proactive and to work with members of Congress, to work with the states and the cities and the counties to ensure that everyone is doing what the best it is that they can be doing.
Well, I would like to just say that to me, without putting God first around us, this world, the way that it is right now, unfortunately, I just got laid off from a job that dealt with transportation for tourism, and they couldn't. We couldn't justify moving 32 people in the morning, having 13 drivers, and having a bus that carries that many people on one shot. So I was laid off. And the one thing I thank God about is that I have a commercial license, so that I sort of have a leeway. But the one thing I will not do, especially and I've lived in Las Vegas for 30 years, is take a job that has to do anything with tourism anymore. Because tourism here in Las Vegas is so bad. I have a friend that was working at the airport, and 3 years ago I worked an economy lot shuttle from the airport to the zero parking to the zero level, and we filled up 3 different parking lots. This year they didn't even fill up the first parking lot, and all I'm saying is that we need help, and some of these people that we're trying to talk to, like our mortgage companies and stuff like that, they're not talking to us. They're waiting until the end, just like what happened with me as far as losing my house, when to me that never should have ever happened. Should have never happened. They had what they wanted. We agreed to give them the amount, and still, a few days later, they tell us, it's not your home anymore. So.
Chairwoman Warren, we have an opening in our food bank for a driver. I'd like to talk to you. Good things can come from
yes,
hearings.
They do.
Good. Any remarks? Or I think Mr. Newman wants to ask a question.
We've heard a lot about the servicers and the lenders being overwhelmed. And I know that our not-for-profits, particularly the housing counselors, are overwhelmed as well. And that's why in New York we've had a specific effort of getting grants. In fact, we've given in the banking department over $2 million in monies that we've collected from fines, in fact, against predatory lenders, to go to housing counselors and legal aid. The state's given $25 million to housing counselors and legal aid because they're mandating now, prior to foreclosure, that individuals have a right to counselors, and if it goes into a foreclosure proceeding, they have a right to legal counsel. Ms. Burks, what is the level of volume and support that your institutions have in terms of providing resources? Can you handle the work? Is there a funding resource, or is there an expertise or staffing need for the organizations in the state?
Yes, the nonprofits have been working around the clock and with local government to do outreach. We could work 24/7 and we couldn't handle the load. There have been some counseling funds that have come down through national. There is no state money to do the work. Staffing is inadequate, and it's going to get worse in 2009. So while you may have expertise, there may be people you could hire, there are no funds to hire more staff. That is not going to happen. So we have to do the best we can with what we have, and we have to change the way we modify loans in this country and in this state.
Thank you.
I want to thank the panel for coming. I appreciate the time that you have put in on this. I know this is difficult to come and tell these stories. I know you work hard to prepare, and I know you work hard every day on what you're accomplishing. So I appreciate it on behalf of the panel, and the second panel is now excused. Thank you very much. We still have in our schedule, I believe we have about 8 minutes left. We are scheduled to leave at 12:30, and we will leave at 12:30. We must leave at 12:30. I'm sorry we don't have more time. I want to remind everyone, we brought, for exactly this reason, a videographer who's out in the hallway so that each of you who wants to talk can talk to the videographer. That gives us a record to take back with us rather than simply our repeating. But we are glad to spend our remaining time. Perhaps the fairest way to allocate that time is if we each just took 1 minute for a person who wants to do that, and perhaps I should start with you, sir.
Well, first I would convey my position to somebody else who would want to
Yes, sir.
So having conveyed that to somebody else in more distinguished capacity, here's what concerns me. It concerns me that we're talking all around the issue. We're not being specific. I want to see the plan. I want to see, just like I'm sitting at the kitchen table, what we're going to do. I want to feel the pain. And there is lots of pain, ladies and gentlemen. There are aberrations in multiple sectors of our society, and you are not going to resolve this unless you go to the heart of it. The money is a distraction for your entertainment and distraction. It is about energy. If you do not move towards energy and move now to stabilize this economy, everything else will be fraught and it will be an exercise in utility. And whenever I hear people talking about financial enterprises, I am disgusted. It is those people who got us into this, and to give these bodies credibility is foolish on top of foolish.
Sir, that's 1 minute. Thank you very much. I want others to have a chance to talk too.
It's about a vision for the country that brings us back to being America, and I'm not hearing the specificity. And there are
Thank you, sir.
manufacturers.
That's 1 minute, more than a minute. Thank you. Yes, sir. In the back, in the gray sweater, could you identify yourself, please, sir?
Yes, my name is Raymond D. Herrera. I'm going to make this as quick as I possibly can. Between my wife and I, we are associated in 3 properties. I lost my position in May of 2008. We have done everything we possibly could with our own savings to help support the people that are renting the homes that we have rented, including our own home, which we reside in, which is in Las Vegas. We have since tapped our resources because of the fact that the other individuals who rent those homes have themselves become victims to this economy. We couldn't do anything towards moving towards trying to address our own loan situation because the banks instructed us that we had to be in default before they would even talk to us. Now that we're communicating with us, they treat us like we're the culprit in the fact that we can't pay the loan anymore. And then you hear sometimes these outside sources that say, you know what, these people are trying to take advantage of the system by trying to get some kind of loan modification. There are 2 things that were brought up here that could really assist those of us. One is mandate forbearance until an issue is resolved, even if it does mean the loss of a home. And the second one is do the adjustment on the bankruptcy so that we can at least address our situation. I mean, everybody's talking about the 3 big auto dealers going back to do bankruptcies to try to resolve their own issues, and yet we ourselves in our own homes of residence don't have that option. So those are 2 things that can be addressed instantaneously, and we don't have to worry about where all this other money's going at this point in time to at least save us right at this moment.
Thank you, sir. Yes, ma'am.
My name is actually Citra, and I have written a proposal on the grassroots real estate addressing the foreclosures and defaults. I know I can upload it, but I do have an extra copy here, and I would like to give it to you. And it seems that everything is trickling down, not getting to us. I want to start trickling up. I don't know whether we have to wait for the new regime administration to come in or not, but my concern, my great concern, is that nothing is being done now, and we do need some help right now. And when I say we, I mean the people who make the banks. Our monies are in the banks, and anyway, can I?
Thank you, ma'am. Yes, ma'am.
Thank you.
Yes, sir.
3 issues.
Yes, sir. Right here on the right.
My name is Stephen Myford. When these properties go into foreclosure, are these lenders receiving mortgage insurance? I mean, is that a motivation for them to let it go into foreclosure? Also, the TARP money that's going out. The banks are receiving this money. Can this money go through the consumer to allow them to buy down the loans, and it still goes to the lender anyway? That's something I want to state.
Thank you, sir. Yes, sir.
Strictly 3 things. Economics.
I got them all.
Obama wants to reissue economics in the middle class of America with dams and bridges and buildings and federal funds. The bailout is a waste, because if you bail them out now, you're going to have to bail them out in the future. But if we go back to our founding fathers, the people that came over here from the old country, and they built equity. The word equity has been lost in the rental of survival, and low income is $750 a month. How in this God's earth can a wage earner that's making $7.50 to $10 an hour afford to live in the economic structure the way it is? Simply, the unions and all the other factions pushed our economic structure lopsided. Now, I've been told that the Ford Motor Company worker gets $50 to $70 an hour, goods and services for his work. They had to put it into the car industry. The basic America is getting back to the low-income people that can afford to live and build some equity. The only option is the mobile home industry that can rebuild mobile homes for low-income housing and buy equity into the future. That's where it has to go, back to the grassroots of earning a right to be counted in life, liberty, and the pursuit of happiness. That's what's wrong, and that's what has to be corrected, and if you don't, stop wasting your time.
Thank you, sir. Yes, ma'am, and then we'll do one more, and then we'll be through. The gentleman in back when she's finished.
My name is Linda Abrams.
Yes, yes,
My
ma'am.
name is Linda Abrams Cooley, and I am a counselor with NID Housing Counseling. And I want to speak to an issue about the loan modification. It is not enough that is being done to help the people that I am working with. The borrowers, they're being offered modifications that the payments are just as high, and sometimes, in some cases, more than what they were already paying, which is not helping them. And then they ask for $20,000, $30,000 up front. Well, if they can't make the mortgage payment, how are they going to come up with $20,000, $30,000? Then they're forced into bankruptcy, and when they're forced into bankruptcy, you go back to the servicer or the lender to try and get a loan modification to bring that payment down so that you can even take it to the judge, which is what they tell you that you need to do. And like Ms. Burke said, they don't talk to each other because you go from one department, and this department tells you you need to talk to the bankruptcy department. The bankruptcy department tells you need to speak to the attorney. The attorney sends you right back, and then it comes back that, well, you know what, we can't do anything for that borrower because the loan is bundled. So we don't even know who the lender is. And so I'm stuck with borrowers that we can't do anything. We don't even have a modification that we can take to the judge and ask that judge if he can do something to bring that payment down. So what do we do with those borrowers? There's just not enough going on to help these people at all. And it's very, very sad. Our hands are just tied.
Yes, ma'am. Thank you. And last question, sir, in the back, if you would identify yourself.
Todd Yoren, resident here in Clark County. Come back to the core of everything that's been said here. Mandatory loan modification. Make them step up. If you're handing them $1 million, make sure that they're handing you $1 million that they've got in existing mortgages that they've done modifications down the loan to value.
I want to close now by thanking all of you. I want to thank you for coming out. I want to thank you for talking with us. I want to thank you for your patience for sitting here for 2.5 hours as we work through this. Please let me say again, if you have not already done so, we're glad to hear and we're glad to make notes, but do talk to the videographer. I really want to make a record of this. I also want to say, if you get the opportunity, click on the website. Remember, it's cop.senate.gov. Click on, add your comments. As we begin to post comments, feel free to add additional comments. I don't think this is going to be over within the next few weeks. Finally, I want to say that the three of us, the panelists, one reason I need to stay on schedule is that we are here today to engage in a formal hearing, to have an opportunity to hear from the public, but we are not through trying to learn at least a little bit about Nevada in our short time here. We're leaving to drive around a little and talk to some more people on a more informal basis. So we hope to see more of Clark County while we're here and learn more. Again, thank you all for coming. This hearing is adjourned.
Nicely done.